August 1923, Berlin. His name is Heinrich Miller. He's a clerk, 42 years old, unremarkable by every measure, and proud of it. For 15 years, Heinrich has done everything correctly. He saved. Every month, without fail, he deposited money into his account at Dresdner Bank. He purchased a life insurance policy. He bought government bonds. His employer, a textile firm, 50 years in business, guaranteed his pension. Heinrich didn't gamble. He didn't speculate. While his friends were buying gold, farmland, and buildings, Heinrich thought them reckless, impulsive, undisciplined. By November of that year, his life savings could not purchase a single loaf of bread. Not because the bank failed. It didn't. Not because the account balance disappeared. The numbers were still there. Not because the insurance policy was cancelled, or the bonds declared void, or the pension revoked. Every promise was still on paper, but the currency those promises were written in had ceased to exist as a store of value. This is the story of Fiscal Historian. And this isn't a story about Germany. This is a story about the architecture of collapse, and why that same architecture is already load-bearing in the United States today. Section break. Title card. Real assets vs. financial claims. Before we perform the autopsy, we need to establish a distinction, one that most financial advisors will never clearly explain to you. There are two fundamentally different categories of wealth. The first, real assets, things with intrinsic use or genuine scarcity, land, physical commodities, productive businesses, precious metals. These carry risk. A farm can fail, a mine can flood, but that risk is isolated. It does not vanish in a single systemic event. Dirt is still dirt. The second, financial assets, claims on future payment, denominated in a specific currency, savings accounts, bonds, pensions, annuities, insurance policies. These are not assets in the truest sense. They are promises, and a promise is only as durable as the system obligated to honor it. Here's the hidden fragility embedded in every financial claim. Currency failure doesn't require hyperinflation. It doesn't require wheelbarrows full of cash or a government declaring bankruptcy. It requires only one condition: that purchasing power declines faster than your nominal return. That's it. That's the entire mechanism. When that threshold is crossed, your account balance can remain completely intact, your bonds perfectly valid, your pension checks arriving on schedule, and you can still be financially destroyed. Let's autopsy the 12 instruments that working American families are told represent safety. Autopsy number 1. Savings accounts. A savings account at a commercial bank is not a pile of money with your name on it, waiting in a vault. It is a liability on the bank's balance sheet. The bank owes you dollars, but those dollars don't exist yet. They've been lent out. You don't own money. You own a promise to be repaid in a currency whose supply is controlled by a body you didn't elect. Here's what that promise has actually been worth. In 1970, a gallon of gasoline cost 36 cents. A savings account might yield 5% annually. Respectable. By 2020, that same gallon cost $2.50. A 594% increase over 50 years. If you deposited $10,000 in 1970 and earned an average of 3% annually, by 2020 you'd hold approximately $44,000. That sounds like growth, until you calculate that $10,000 in 1970 had the purchasing power of roughly $75,000 in 2020. You saved your money. You lost 2/3 of its value. No fraud occurred. No crisis erupted. The system functioned exactly as designed and quietly transferred your wealth to those on the other side of the ledger. Autopsy number 2. U.S. Treasury Bonds. Treasury bonds are sold as the safest investment on earth, backed by the full faith and credit of the United States government. Let's translate that phrase carefully. What it means: you are holding a claim on future tax revenue, denominated in a currency that must be continuously debased to service the very debt you are funding. As of mid-2024, the United States carries over $34 trillion in federal debt. Interest expense alone now exceeds $1 trillion annually. There is no plausible scenario in which that debt is paid down. It can only be rolled over, refinanced, or inflated away. In every historical currency crisis, government bonds denominated in the failing currency are not the last asset destroyed. They are the first, not through default. Through devaluation. Argentina has restructured its sovereign debt 9 times since independence. Russia defaulted in 1998. Greece restructured in 2012, with bondholders absorbing losses between 50 and 75%. In every case, the nominal contract was honored. In every case, the currency made it worthless. A Treasury bond is not a safe harbor. It is ground zero, a bet that the United States will remain the singular exception to the entire recorded history of sovereign finance. Consider carefully what that bet actually requires. Autopsy number 3, whole life insurance. A whole life insurance policy promises to pay your beneficiaries a specific dollar amount upon your death. The language is precise. The figure is guaranteed. It sounds like bedrock, but that guarantee is backed by the insurance company's investment portfolio, which, by regulatory requirement, is heavily weighted toward Treasury bonds and investment-grade corporate debt, all dollar-denominated, all subject to the same structural vulnerabilities we just described. If the dollar loses 50% of its purchasing power, your $250,000 policy pays out exactly $250,000 in currency that buys what $125,000 used to buy. The contract was honored. The math destroyed you. This is not a hypothetical. In the 1970s, insurance policies written in the 1950s and 60s paid out in dollars that had lost more than half their real value. Widows received their death benefits on schedule. The money could not cover funeral costs. The system worked precisely as designed. Autopsy number 4, fixed annuities. An annuity is marketed as the ultimate retirement safety net. You surrender a lump sum today. In return, you receive a guaranteed monthly payment for the rest of your life. What you're actually doing is trading present dollars for future dollars and locking in the exchange rate at the moment. The issuer has every incentive to allow inflation to erode your payout. Suppose you purchase an annuity in 2024 that pays $2,000 per month. At 5% average annual inflation, in 10 years that payment has the purchasing power of approximately $1,200 in today's terms. In 20 years, less than $800. Your check never changes. Your standard of living collapses in slow motion. Insurance companies favor annuities for one reason. They invest your principal in higher-yielding instruments while paying you fixed nominal returns. The inflation gap between what they earn and what they pay you is profit. You are not buying security. You are purchasing a structured decline. Autopsy number 5, Social Security. Social Security is the modern structural equivalent of the 1933 gold confiscation. You are compelled to pay into the system across your entire working life. In return, you receive a promise of future payments denominated in dollars. The Social Security Trust Fund does not hold your contributions in reserve. It holds special issue Treasury bonds, which, again, are claims on future dollars. According to the 2023 Trustees Report, the Old Age and Survivors Insurance Trust Fund is projected to reach depletion by 2033. At that point, incoming payroll taxes will cover approximately 77% of scheduled benefits. 3 options remain at that juncture: cut benefits, raise taxes, or expand the money supply to fill the gap. History is unambiguous about which option governments choose. In 2010, Argentina's government seized $30 billion in private pension assets and replaced them with government bonds. Retirees were promised they would be made whole. The peso collapsed. They were not. This is not a prediction about America's future. It is a description of a historical playbook. Autopsy number 6, municipal bonds. Municipal bonds are loans to state and local governments, often marketed with the additional appeal of federal tax exemption. The backing of tax revenue sounds like genuine security, until you examine the issuers. Illinois carries over $143 billion in unfunded pension liabilities. California exceeds $200 billion. New Jersey's pension system is funded at less than 40%. States cannot print money. Their only tools are taxation, borrowing, and service cuts. Detroit declared municipal bankruptcy in 2013. Bondholders took a reduction. Pensioners took a reduction. The city survived. The promises did not. Puerto Rico defaulted on $70 billion in obligations in 2016. Litigation continues. Municipal bonds are not risk-free instruments. They are a wager on the long-term fiscal solvency of specific issuers. In a dollar environment where real tax revenues can collapse even as nominal obligations remain fixed. Autopsy number 7, pension funds. Pensions may be the most psychologically cruel instrument of all, because they are so deeply interwoven with the concept of a life well worked. A defined benefit pension promises a specific monthly income in retirement. That promise is only as durable as the fund's ability to meet its future obligations. And the math underlying most pension funds is structurally broken. Most funds assume annual returns of 7 to 7.5%. That assumption is used to calculate current funding requirements. Since 2008, most funds have consistently underperformed that target. The gap between assumed and actual returns creates an unfunded liability. The Federal Reserve's 2021 data estimates total unfunded liabilities for state and local pensions at over $1.3 trillion. In 2014, the Central States Pension Fund, covering over 400,000 Teamsters, announced it would exhaust its reserves by 2026 unless benefits were slashed by half. Workers who had been promised $3,000 per month faced reductions to $1,500 or less. They did everything asked of them. They worked union jobs for decades. They paid into the system faithfully. The system failed them anyway. According to the Equitable Institute, the aggregate funding ratio for state pensions sits at approximately 75%. For every dollar promised, 75 cents exists in reserve. And that reserve is invested in bonds that lose purchasing power when inflation rises. This is where the structure fractures. Autopsy number 8. FDIC insured deposits. The FDIC insures deposits up to $250,000 per depositor, per insured institution. That insurance is real. What it covers is often misunderstood. The FDIC's deposit insurance fund held approximately $125 billion in reserves at the end of 2023. Total insured deposits in the U.S. banking system, over $10 trillion. That is a coverage ratio of roughly 1.25%. In a systemic banking crisis, the FDIC does not have the reserves to cover even a moderate wave of simultaneous failures. The mechanism in that scenario: the FDIC borrows from the Treasury borrows from the Federal Reserve, and the Federal Reserve expands the money supply. Your deposit is insured. You receive your dollars. Those dollars, however, are worth less because the supply of dollars was expanded to manufacture them. This is precisely what occurred in 2008. Failed institutions were backstopped. The Fed's balance sheet expanded from approximately $870 billion in 2007 to over $2.1 trillion by year's end. The dollar did not collapse. Purchasing power eroded, masked by suppressed inflation reporting. The FDIC is not a vault. It is a government guarantee, denominated in a currency the government holds the authority to create. Autopsy number 9. Series ID savings bonds. Series E savings bonds are marketed as safe, patriotic, and reliable. The government guarantees they will double in value over 20 years. That is a nominal doubling. At 4%. Average annual inflation, a figure that has been exceeded repeatedly in recent years. A $20,000 bond redemption in 20 years carries the purchasing power of approximately $9,100 in today's terms. You lent the government money for 20 years, interest-free in real terms. They repaid you in depreciated currency. This is not theoretical. Bonds issued in the 1960s and redeemed in the 1980s produced exactly this result. Holders received their principal. That principal could not purchase what it once could. No default occurred. The currency did the work instead. Autopsy number 10. Prepaid instruments. Prepaid debit cards, store credit, gift cards, layaway balances. These are dollar-denominated balances held as corporate liabilities. In bankruptcy, you are an unsecured creditor, behind bondholders, secured lenders, and attorneys. You receive what remains, if anything. In 2011, Borders bookstore collapsed. Gift card holders received nothing. In 2018, Toys R Us liquidated. Gift card balances became worthless overnight. Even when the company survives, inflation continuously erodes the purchasing value of any fixed balance. You are holding a melting asset with no government backing, no inflation protection, and no priority claim in insolvency. Working families collectively hold billions of dollars in these instruments. Autopsy number 11. Money market funds. Money market funds are described as cash equivalents, stable, liquid, and reliable. They are designed to maintain a net asset value of exactly $1 per share. In September 2008, the Reserve Primary Fund broke the dollar. Its net asset value fell to 97 cents per share after holding $785 million in Lehman Brothers debt. The resulting panic triggered $300 billion in withdrawals from money market funds in a single week. The Treasury deployed an emergency guarantee program. The Federal Reserve created emergency lending facilities. The system survived, barely, and only through extraordinary intervention. The lesson is direct. Money market funds are not cash. They are portfolios of short-term debt instruments. If that debt fails, the fund fails. And in a dollar crisis, short-duration debt is no more protected than long-duration debt. You don't own dollars. You own shares in a fund that owns promises. Autopsy number 12 to 401k bond funds, the final instrument, the one affecting the most households. Many Americans hold a significant portion of their 401k allocations in bond funds, particularly those approaching or in retirement, who have been guided toward conservative positions. Bond funds are not bonds. You do not hold an instrument to maturity. You own shares in a fund that holds bonds. When interest rates rise, bond prices fall. If you require liquidity during a rate spike, you sell at a loss. When inflation rises, bonds lose real purchasing power. Even held to maturity, you are repaid in depreciated dollars. According to Vanguard's 2023 data, the average American 401k balance stands at approximately $120,000. If 40% is allocated to bond funds, $6,800, that is $48,000 sitting in inflation-sensitive, dollar-denominated paper. That is not a retirement. That is a wager that the currency remains stable. History, examined carefully, does not favor that wager. Closing, who wins and who loses? The forensic question now becomes, in this structure, who survives? Governments survive. They issue debt in their own currency. When that currency devalues, the debt becomes easier to service. Inflation is a slow-motion default, one that requires no announcement and generates no headlines. Banks survive. They borrow short at low rates, lend long at higher rates, and repay depositors in dollars made cheaper by the very expansion that covered the shortfall. Real asset holders survive. Those who own land, commodities, productive businesses, and equities see nominal prices rise with inflation. They may not be wealthier in real terms, but they are not being destroyed. Who loses? Wage earners who save in cash, retirees on fixed incomes, pension recipients, holders of bonds, annuities, and life insurance policies, people who trusted the system. The system is structurally designed to favor debtors over creditors. The largest debtor in the world is the United States federal government. Total federal debt exceeds $34 trillion. Unfunded liabilities for Social Security and Medicare add another $76 trillion. According to the 2023 financial report of the U.S. government, there is no politically viable path to settling that obligation in hard currency. The only mechanism that works, the one that has always been chosen, is to devalue the currency, slowly enough that the population doesn't recognize the transfer, until it has already occurred. This is not a conspiracy. It is an incentive structure. Politicians secure re-election by promising benefits. Those benefits are denominated in future dollars. Future dollars can be manufactured. Present dollars cannot. The mathematics lead in one direction. Outro: we are not Weimar Germany. We are not Zimbabwe. The collapse is not imminent. The structure, however, is the same. National debt growing faster than GDP. Entitlement obligations accelerating. No political will to cut spending. Tax capacity insufficient to close the gap. The Federal Reserve's balance sheet expanded from under $1 trillion in 2008 to nearly $9 trillion in 2022. To money supply increased by over 25% between February 2020 and February 2021, the fastest peacetime monetary expansion in American history. The currency didn't collapse, but every dollar-denominated claim issued before that expansion was quietly, incrementally worth less. In every currency crisis across recorded history, the assets destroyed first are not the reckless ones, they are the prudent ones. The savings accounts, the government bonds, the pension funds, the insurance policies, not because they defaulted, because the currency they were written in was quietly retired. The family that saved responsibly, held bonds, trusted the pension, and kept cash in the bank ends up with nothing. The family that held land, physical assets, and stayed out of dollar-denominated paper survives. That is not a moral judgment. It is a historical pattern, and the pattern is already in motion.